For nearly 50 years, the global oil market has operated on a single unspoken rule. Oil is priced in dollars, not euros, not yen, not gold. Dollars. This rule was never written into law. It was never voted on by Congress. It was never ratified by the United Nations. Yet it became one of the most powerful economic arrangements in modern history. And now, quietly, deliberately, that rule is being tested. Saudi Arabia, the cornerstone of the global oil system, is negotiating energy sales to China priced in Yuan. Not as an experiment, not as a symbolic gesture, but as a structural alternative. If finalized at scale, this would represent the most serious challenge to the petrodollar system since its creation. And the consequences would extend far beyond oil. Why the petrodollar exists at all. To understand why this matters, you have to understand why the petrodollar exists. In 1971, the United States broke its final link to gold. The dollar became a fiat currency, backed not by metal but by trust. That trust needed reinforcement. In 1974, the U.S. reached a quiet agreement with Saudi Arabia. The deal was simple but powerful. Saudi Arabia would price oil exclusively in U.S. dollars. In return, the U.S. would provide military protection, security guarantees, and access to American financial markets. Other OPEC nations followed. Oil, the most important commodity on earth, became inseparable from the dollar. And a new system was born. How oil created artificial demand for dollars. The petrodollar system created a permanent global demand for U.S. dollars. Every country that needed oil needed dollars. Every central bank needed dollar reserves. Every trade imbalance fed back into U.S. financial markets. This allowed the United States to run persistent deficits without suffering the consequences most nations would face. The world recycled its surplus dollars back into U.S. treasuries, equities, and real estate. America consumed. The world financed it. Why the system is now under pressure? The petrodollar did not collapse suddenly. It eroded slowly. Three forces began weakening it. First, U.S. home sanctions policy turned the dollar into a geopolitical weapon. Countries learned that holding dollar reserves carried political risk. Second, China became the world's largest energy importer. Yet it had no control over the currency used to buy that energy. Third, Saudi Arabia's strategic interests began to diverge from Washington's. These pressures did not break the system overnight, but they created incentives to build alternatives. China's long-term strategy was never subtle. China has never hidden its ambition to reduce dollar dependence. It launched the Shanghai Petroleum and Natural Gas Exchange. It expanded yuan-denominated commodity contracts. It built currency swap lines across Asia, Africa, and the Middle East. But these efforts lacked one thing: scale. Without a major oil producer willing to transact outside the dollar, alternatives remained symbolic. Saudi Arabia changes that. Why Saudi Arabia is the pivot point. Saudi Arabia is not just another oil exporter, it is the anchor. When Saudi Arabia moves, markets listen, pricing norms follow, financial infrastructure adapts. Saudi Arabia has leverage because it controls supply, and because it has options. China is its largest customer. The U.S. is no longer its only security guarantor, and Vision 2030 demands diversified capital inflows. Saudi Arabia does not need to abandon the dollar entirely. It only needs to introduce choice. The Yuan deal is not about replacing the dollar overnight. This is where most commentary gets it wrong. The Saudi-China Yuan oil deal is not designed to dethrone the dollar tomorrow. It is designed to fracture exclusivity. Once oil can be priced in multiple currencies, the dollar loses its monopoly premium. Even partial diversification weakens the automatic recycling of dollars into U.S. assets. That is the real threat. Why the U.S. can't easily stop this. In previous decades, the United States could enforce dollar dominance through diplomacy, pressure, or force. Today, the constraints are different. China is the largest trading partner for most of the world. Sanctions fatigue has set in. And multipolar finance is no longer theoretical. Saudi Arabia understands this. It is not choosing China over the US. It is choosing leverage over dependence. What happens? When oil stops needing dollars. If oil demand no longer automatically creates dollar demand, several things happen simultaneously. Foreign central banks reduce dollar reserves. US borrowing costs rise structurally. Dollar liquidity becomes less abundant globally. None of these effects are immediate, but they are cumulative. This is how reserve systems change. Slowly, quietly, then suddenly. Why markets are underestimating this shift? Markets tend to price visible events, not structural transitions. A single yuan-denominated oil contract does not move markets. A system slowly losing its exclusivity does. This is not a trade headline. It is a monetary evolution, and it is still unfolding. Currency power is built on commodities. No currency becomes dominant because it is well managed or morally superior. Currencies become dominant because they are required. The British pound ruled global finance when it priced global trade in commodities. The US dollar replaced it when oil, shipping, and reconstruction demanded dollars. Reserve status is not about trust alone, it is about necessity. China understands this better than most observers in the West. China's structural currency. Problem China is the world's second largest economy, the largest exporter, and the largest importer of energy. Yet its currency, the Yuan, plays a limited role in global settlement. That imbalance is not ideological, it is structural. China runs persistent trade surpluses. It accumulates foreign currency. And it must recycle those surpluses into assets it does not control, primarily U.S. treasuries. This exposes China to two risks. First, currency risk. Second, geopolitical risk. Why energy imports? Are the pressure point, China imports more oil than any country on earth. Every barrel priced in dollars forces Chinese firms to source dollars, hedge currency exposure, and remain dependent on offshore liquidity. Pricing oil in yuan changes that equation. It allows Chinese companies to settle energy trade in their own currency. It reduces dollar demand at the margin. And it increases offshore yuan circulation. This is not about symbolism, it is about plumbing. The role of the Shanghai oil futures market. China did not approach Saudi Arabia unprepared. Years earlier, it built the Shanghai Petroleum and Natural Gas Exchange, launching yuan-denominated crude oil futures. These contracts were designed with one critical feature: convertibility into gold. Oil producers accepting yuan could exchange it for physical gold through Shanghai and Hong Kong. This bridged a trust gap. China could not export financial credibility, but it could export convertibility. Why Saudi Arabia is willing to listen. Saudi Arabia's motivations are pragmatic, not ideological. China is its largest oil customer. Asia is its future demand center. Dollar exposure no longer guarantees political alignment. Saudi Arabia wants optionality. Pricing some oil in yuan gives Riyadh leverage in negotiations with Washington, flexibility in reserves management, and access to Chinese capital markets. It does not require abandoning the dollar. It only requires diversification. Why? This isn't just about China and Saudi Arabia. Other producers are watching closely. Russia already accepts non-dollar payments under sanctions pressure. Iran has little choice. The UAE is experimenting with bilateral settlement frameworks. What Saudi Arabia legitimizes, others normalize. This is how systems shift, not through collapse, through precedent. Why the dollar's role is still strong. For now. It is important to be precise. The dollar is not disappearing. The petrodollar system is not collapsing tomorrow. The dollar remains dominant because it is liquid, deep, and embedded in global finance. But dominance and exclusivity are not the same thing. The moment exclusivity ends, the premium begins to erode. The hidden impact on U.S. financial markets. The petrodollar system did more than price oil. It recycled global surpluses into U.S. assets. Foreign oil exporters parked dollar earnings in treasuries. This suppressed yields. It financed deficits cheaply. As oil trade diversifies, that automatic recycling weakens. The effect is gradual, but persistent. Why this matters? More in a high-debt world. In a low-debt environment, reserve erosion is manageable. In a high-debt environment, it is dangerous. The United States now runs deficits that assume continued foreign demand for dollar assets. Any structural decline in that demand raises borrowing costs. Not dramatically at first, but enough to matter over time. Why markets struggle to price. This transition. Markets are excellent at pricing shocks. They are terrible at pricing slow, political, structural change. A UN oil contract does not trigger a sell-off, but the normalization of alternatives alters expectations. Expectations move capital. China's endgame is not dollar replacement. China does not need the yuan to replace the dollar. It needs the dollar to lose exclusivity. In a multipolar system, China gains autonomy without assuming responsibility for global liquidity. That is the optimal outcome. Why reserve currencies rarely collapse? Reserve currencies do not fail the way companies fail. They do not go bankrupt. They do not disappear overnight. They do not collapse on a single headline. They erode. The danger is not a sudden rejection of the dollar. The danger is gradual irrelevance, where the dollar remains dominant but no longer indispensable. That distinction matters. The myth of the sudden dollar. Collapse. Popular narratives. Imagine reserve transitions as dramatic events, a crisis, a run, a replacement. History tells a different story. The British pound did not lose reserve status when Britain declined. It lost it slowly, over decades, as alternatives emerged and usage diversified. The pound continued to exist. It continued to trade. But it no longer sat at the center. The same pattern is now visible in the dollar system. The three phases of reserve currency erosion. Every reserve transition follows a similar arc. First comes dominance, where the currency is not just preferred but required. Second comes coexistence, where alternatives are tolerated and occasionally used. Third comes normalization, where the reserve currency is one option among many. The Saudi-China Yuan oil deal is a coexistence signal, and coexistence is the most dangerous phase. Why coexistence? Weakens demand, invisibly. As long as oil is priced only in dollars, demand for dollars is automatic. Once alternatives exist, demand becomes discretionary. Discretion changes behavior. Central banks diversify quietly, corporations hedge differently, trade settlements fragment. None of this causes a crash, but all of it reduces structural demand. Why the US benefited from invisible privilege? For decades, the United States enjoyed what economists call an exorbitant privilege. It could borrow cheaply. It could run deficits without penalty. It could export inflation. This privilege was not based on policy brilliance. It was based on necessity. The world needed dollars. What happens? When necessity becomes choice. When necessity becomes choice, pricing changes. Borrowing costs reflect risk. Capital demands return. Deficits become visible. The system does not break. It tightens. Why this matters? More than trade. Volume's critics often point out that Yuan oil trades represent a small fraction of global volume. That misses the point. Reserve systems are not defined by volume alone. They are defined by precedent. Once a system allows alternatives, participants begin to plan for them. Planning changes flows long before volume does. Why Saudi Arabia's signal is more important than China's China has been advocating for de-dollarization for years. Markets largely ignored it. Saudi Arabia is different. Saudi Arabia is not ideological. It is central. It is credible. When Saudi Arabia accepts Yuan, it tells the world that dollar exclusivity is no longer sacred. That message travels fast. Why the US cannot reverse this with policy alone? The US can defend the dollar with interest rates, diplomacy, and sanctions. But it cannot force foreign nations to prefer dollar settlement if alternatives exist. Trust can be encouraged. Dependence cannot be enforced forever, especially in a multipolar world. The sanctions feedback loop sanctions accelerated this transition. By weaponizing access to the dollar system, the US increased the incentive to build alternatives. Each sanction reinforces the lesson. Access can be revoked. This does not cause immediate abandonment. It causes preparation. Why preparation is the real risk markets. Underestimate preparation because it is quiet. Swap lines are negotiated. Payment systems are built. Settlement frameworks are tested. None of this moves prices. Until it does. The shift from dollar recycling to dollar retention. Under the petrodollar system, surplus dollars flowed back into US assets. As alternatives grow, surplus dollars are retained elsewhere. They buy regional assets. They fund domestic projects. They support alternative trade networks. This reduces capital inflows to the US over time. Why this matters in a high-rate environment. In a low-rate world, this shift would be manageable. In a high-rate, high-debt world, it becomes painful. The US must refinance massive deficits continuously. Even small changes in demand matter. Why markets will notice? Too late. By the time markets fully price this transition, it will already be mature. Reserve erosion is visible only in hindsight. The warning signs appear years earlier. The Saudi-China Yuan oil deal is one of those signs. What this means going forward. This is not about choosing sides. It is about understanding structure. The petrodollar system is not collapsing. It is being diluted. And dilution changes everything. Why the end of exclusivity changes. Everything. The most dangerous misunderstanding about the petrodollar debate is the belief that it ends with collapse. It doesn't. The end of the petrodollar, if and when it comes, will not look like a crisis. It will look like adjustment. Slow, persistent, structural adjustment. The dollar will not disappear. Oil will still trade in dollars. US markets will remain central. But the automatic privileges that defined the last 50 years will quietly weaken. And that is where the real consequences begin. The silent shift in capital flows. For decades, global capital followed a predictable path. Oil exporting nations earned dollars. Those dollars flowed into US treasuries, equities, and banks. America financed deficits at artificially low cost. This recycling was not guaranteed by policy. It was guaranteed by structure. As oil trade diversifies, recycling becomes optional. Optional flows are fickle flows. They demand higher yields. They tolerate less risk. They leave faster. Why US borrowing costs matter more than exchange rates. Most people have focused on the dollar's exchange rate. That's the wrong metric. The real vulnerability is borrowing cost. The United States must refinance trillions of dollars in debt continuously. Even modest increases in rates translate into massive fiscal pressure. When foreign demand becomes discretionary rather than structural, borrowing costs become sensitive. That sensitivity reshapes policy. Why inflation risk becomes structural, not cyclical. A world with weaker dollar recycling has less tolerance for excess. Deficits become inflationary more quickly. Monetary easing becomes more visible. Policy mistakes carry faster consequences. Inflation becomes less episodic and more persistent. Not because policymakers lose competence, but because the margin for error shrinks. Why this forces harder trade-offs. The petrodollar system allowed the United States to delay trade-offs. It could stimulate growth without raising taxes. It could fund wars without immediate domestic cost. It could absorb shocks without repricing capital. A diluted system removes that buffer. Choices become explicit. What this means for global stability. Multipolar monetary systems are not inherently unstable, but they are less forgiving. They lack a single shock absorber. They distribute stress unevenly. They reward coordination less and discipline more. This raises volatility, not explosively, but persistently. Why energy? Pricing is still the key. Variable oil remains foundational, not because it is scarce, but because it is indispensable. Whoever influences energy pricing influences currency demand, capital flows, and geopolitical alignment. That is why the Saudi-China Yuan oil deal matters, even if volumes remain small. It introduces flexibility where rigidity once ruled. Why Saudi Arabia is acting rationally. Saudi Arabia is not attacking the dollar. It is hedging its future. A nation dependent on one currency system inherits that system's risks. Diversification is not rebellion. It is insurance. Saudi Arabia is behaving like a rational reserve manager. Why the United States still has time. This is not a terminal diagnosis. The United States retains immense advantages: deep capital markets, legal transparency, military reach, innovation capacity. But time does not mean immunity. It means opportunity to adapt. What adaptation would require? Adaptation requires acknowledging reality, that exclusivity is ending, that multipolar finance is inevitable, that discipline matters more than dominance. It would require fiscal restraint, credible monetary policy, and strategic diplomacy. These are political choices, not market ones. Why markets? Will eventually reprice. This reality. Markets are slow to price structure. They respond to crisis, not preparation. But when repricing comes, it is not dramatic. It is relentless. Higher term premiums, more volatility, less tolerance for excess. The world becomes more expensive to finance. What investors miss about this transition? This is not about betting against America. It is about understanding systems. The petrodollar system shaped behavior for 50 years. Its dilution reshapes behavior for the next 50. Capital adapts faster than ideology. Why this moment will be studied. Later. In hindsight, historians will not point to a collapse. They will point to moments like this: quiet negotiations, incremental deals, normalization of alternatives. That is how systems change. The final reality. The Saudi-China Yuan oil deal is not the end of the dollar. It is the end of unquestioned dominance. And in global finance, questioning changes everything. Final thought: reserve currencies do not die. They age. And aging systems demand discipline, not denial. The petrodollar is under fire, not from an enemy, but from evolution. And evolution is relentless.